stocks give up their early gains as investors remain wary of US President Donald Trump's flip-flop on China tariffs and Fed Jerome Powell. IT, autos and realty gain, but consumer durables, energy and financials drag.
HCL Technologies climbs despite a soft and mostly in-line quarter on the back of strong deal wins and an all-time high order pipeline. Expectations of easing tariff tensions also fuel a rally in IT stocks. HCL Tech is the top Nifty gainer today.
EU Small Finance Bank CEO Sanjay Agrawal says collections against microloans in Karnataka have improved to 98% in March from 95% in January, giving hope that the worst of the microfinance stress is behind the company.
Havells chairman Anil Rai Gupta says demand in rural and semi-urban areas is coming back. Premiumization is a trend witnessed not just in urban areas, but rural areas too.
Electric two-wheeler maker Waaree Energies is all set to launch its IPO, the first main board issue this fiscal on April 28th. The offer comprises a fresh issue of about 2,600 crore rupees and an offer for sale by the promoters and early investors.
You're watching us here on Halftime Report. It's halfway through the trading session. I'm Mangla Malu. With me, Surabhi Upadhyay. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. It's an interesting day of trade. Why do I say that? Because we're at 24,200 on the Nifty, no real problems, consolidating near highs that we've seen in 2025 so far itself. But after a big solid run, the Nifty Bank is allowed a day of rest. It's down about 0.2%. And after a lot of days of rest, it's the IT pack which has said that I'll take the mantle from you and I'll move forward. The IT index actually has done extremely well this week so far, telling you that maybe, just maybe, the worst would have been in the price, because we got numbers from Infosys that after the stock moved higher, we got numbers from HCL Tech, nothing really to write home about in the numbers, but the street believes that, well, perhaps that's in the price.
Absolutely, and I think IT stocks swing like small caps or micro caps these days. You have one day of major up move like the one that we're witnessing today, and then you have other major declining days. I think today's swing in IT could also have to do with the fact that overall there's risk on in global markets, and that's thanks to the first headline that we told you about, that Mr. Donald Trump now seems to be making up his mind that he doesn't want to fire Jerome Powell and that he's willing to de-escalate, make some sort of a trade deal with China. So that's why overall there's a risk on in global markets. US markets did well. US futures are holding up really well. And, that would spell perhaps better times for IT companies, particularly the large ones that have exposure to the US.
Just to add to that, we pointed this out on Monday when the Nifty Bank hit a fresh record high, that the Nifty Bank has hit a fresh record high. So that's 0% distance from, a record high. IT index is still about 23% away from the record high. So the Nifty Bank's outperformance versus the IT index is close to around 25, 26 odd percent. So there's a fair amount of gap that the IT index needs to fill. And if that were to happen, then who's to say that the Nifty won't go and hit the record high, which it's about 5-6% away from right now?
Absolutely. IT is actually, taking the top honors. By the way, the rest of the market is not too bad either. The mid-cap market is still slightly outperforming the Nifty. In the earlier part of the morning, mid-caps had also sold off, but now we're seeing some momentum come back, very, very, specific to individual stocks. Though today's advanced decline ratio is negative. After many days, you still have more declining stocks than advancing stocks right now. So that's the shape of the market. But since those are the crisscross lines, so still the red is towering over the green. But since we're talking about IT and that's the big sector in focus today, let's go across to Rima. She has a report card with her of all the large IT companies that have reported Q4 performance so far. Rima?
Well, it's the rubber from NASDAQ overnight, but I just want to quickly recap how the quarter has been for the large cap IT companies now that all the four of them have reported their numbers. Well, on the whole, Q4 has been a soft quarter. Revenue for all the four IT company, large cap companies declined on a quarter-on-quarter basis. The steepest decline seen was for Infosys with a drop of about 3.5%. The commentary from the companies were also fairly cautious. They said clients are in a wait-and-watch approach. There are delays in starts of new projects. Discretionary spending is likely to remain subdued, and the companies fear stress, particularly in the automotive vertical, which falls under manufacturing, and then the retail CPG vertical. That said, cost optimization deals are very much on track. The silver lining in Q4 were the very strong deal wins across the board. Look at the numbers. For HCL Tech, deal wins were up 40% on a sequential basis, nearing $3 billion. TCS's order book swelled by 20% quarter on quarter to $12.2 billion. Infosys' large deal wins were up 6%, while for Wipro, TCV, that's total contract value of deal wins, was nearly $4 billion. Again, a jump of 14% quarter on quarter. So even though Q4 got impacted on account of the macro uncertainty, the deal wins continue to remain very robust. Now the FY26 guidance. Well, Wipro's Q1 guidance, which is the near-term guidance for the next 3 months till the June quarter, was a howler, -3.5% to -1.5%. But if you strip that out, for the full year, the guidance is not as bad as what the street was fearing. Infy is talking about 0 to 3% growth, HCL Tech 2 to 5%, and TCS is saying, at least for their major markets, which is stripping out, India, the BSNL deal, FY26 should be better than FY25, and margin guidance has remained unchanged both for HCL Tech and Infosys. And when you round up FY25, well, it's been a very low growth year. For Wipro, it's the second consecutive year of a top-line decline, but even for the others, like in HCL Tech, Infy and TCS, we are looking at just about a 4 to 5% kind of a top-line growth. In FY26, by all accounts, and the FY26 guidance is again going to be a very low growth year for the, at least, IT companies, large-cap IT companies. Back to you.
All right, Rima, thanks a lot for that. That's about the IT pack. But while we've spoken about the IT pack, don't lose sight of the way the pharma stocks are moving today. In fact, the pharmaceutical stocks also doing extremely well. Pull up something like Dr. Reddy's and Sun Pharma from the frontline names and the broader market names. We have Alchem Lab, which has moved higher. Aurobindo Pharma, suddenly over the last, 2 minutes or so, has seen a further up move. This after the big drug approval that the company has gotten as well. So the pharmaceutical stocks are picking pace, and we're also seeing some traction in names like Nykaa. Remember, Nykaa has been, gaining ever since the company reported their fourth quarter update, which was much better than all the other consumer stocks in, this quarter and the last few quarters as well. The beauty and personal care business has been doing well. So as a result of which, Nykaa, again, very close to its 52-week high, at least for this year. And we're seeing some traction on Nykaa too. But stocks which are doing extremely well, AU Small Finance Bank, shares are rallying on the back of their fourth quarter earnings. We caught up with the management. CEO Sanjay Agarwal joined in, and he said that collections against microloans in Karnataka actually improved to 98% in March from 95% in January. This gives hope that the worst of the microfinance stress may perhaps be behind. Remember, all of last year, all these small financiers were actually worried about the microfinance stress, and now any hope of that being behind, the worst being behind, has the street excited. This stock higher as well. This is our special Insight Edge segment. That's AU Small Finance Bank.
From last 2 months, things have changed dramatically, in my opinion, and I would give credit to the regulator and, of course, the government itself that the focus on growth is back. This year, our credit cost will help us more to build our ROA. So I expect a reduction in credit cost this year, and I'm saying because we are well prepared. So I would say March has given us hope, because in March month, the OD recovery there is around 98%, right, which was around 95 in the January month. And I'm not seeing many noises from that market now. So, and that is only a 10% of our book. So even that we have counted that book in our current year planning, right? So I don't think Karnataka would play a spoil sport for us this year.
All right, that's the word from AU Small Finance Bank. We have to take a quick break on that note. On the other side, we'll get you more on the markets, and we'll put the spotlight on a couple of stocks: Aurobindo Pharma, Havells, and Cyient DLM. Welcome back. Here with us on Halftime Report. Let's put the spotlight on a couple of those stocks like we promised. Aurobindo Pharma is in focus. The company has received US FDA approval for a drug which is used in the treatment of certain types of leukemia. Vinny is here with more details. Stocks up 2.5%. Seems important for the company, Vinny?
Absolutely. It's an important drug when you look at it, a good market size as well. Now, firstly, this is Eugia Pharma, wholly owned subsidiary of Aurobindo Pharma, which has received this final approval for this drug that is called dasatinib. And this is a generic drug for BMS, which already had this drug going on. So they were the main innovators. Now, obviously, there are a lot of generic players who have come into this drug as well. This product launch for Aurobindo Pharma is expected in Q1 FY26. Estimated market size is $1.8 billion, and this is as of Feb 2025. So last 12 months data, this is what is indicated, $1.8 billion. Now, like I was saying, there are other players who have already come into it, right? In the month of March, we had seen Zydus receive a final approval for the same drug as well. Tentative approvals have come in for a lot of other players as well, whether you look at Dr. Reddy's, Biocon, and globally also there are players who have received approval. So yes, there is a lot of competition that has increased, but analysts had, highlighted that the sales expected from this drug for Zydus was around $10 million per quarter. So, still a big amount of sales that come in, and similar level we could expect from Aurobindo Pharma as well. So still a good positioning that they could have in this drug. Important treatment drug as well coming in front on the point of view from leukemia, cancer treatments. So that is important for the company there.
All right, we take that point, and that's reflecting in the way, the stocks moved as well. Havells is the other stock which is on our radar after their fourth quarter numbers did come by. While the Lloyd's business did well, the stock's still lower in today's trading session. Why is that? Upasna joins in to tell us more. Upasna.
Well, certainly the stock is seeing a bit of a profit booking despite good results. Now, if we talk about the Q4 numbers, they stood above our poll estimates, and this growth was mainly led by companies Cable and Wire and Lloyd business. Now, higher copper prices and robust RAC demand has supported growth this time around. Company has also indicated that it is targeting 13 to 14% margin going forward. Now, let us come to the numbers first. The revenue saw an uptick of 20%, which was supported by 21% growth in cables and wire segment, and margins in this segment also remain stable at 12%. Lloyd, the revenue grew by nearly about 40% on a YoY basis due to robust RAC demand. Now, coming to the margins of the company, overall they stood at 11.6%, which is much above the poll estimate of nearly about 10.4%. PAT saw an uptick of 11%, stood around 517 crore. Now, the management joined us earlier this morning to talk about the demand trends and outlook for FY26, in which management has said that the cable segment is witnessing a demand uptick, but wire segment is experiencing challenges on the volume growth front. There are no concerns regarding the supply chain, especially for compressors, is what they've indicated. And they think with the entry of Ultratech and Adani and the new entrants entering the space, the competition intensity remains quite positive for the players. It thinks that the newer brand entry will consolidate market share from unorganized to organized, and demand trends are also indicating more premiumization. Q4 saw strong growth coming back to rural and semi-urban area is what the management has emphasized. So overall, good set of numbers and even robust commentary. Let's listen into what management has to say.
I would say, we are, you talked about the newer competition coming in. This industry is a very large part of the electrical industry, and I think it is still has fairly a good share of the unorganized and the non-branded sector. So newer brands, better quality brands, hopefully, should actually consolidate market shares from the unorganized sector. So overall, I think it might not be a bad thing for the industry. I think this was one quarter where we actually saw growth coming back in the rural and semi-urban sector as well. The urban had been doing better in the first half of the year. The rural was impacted. It's coming back. Maybe some impact of the budget changes as well as the RBI relaxations. Hopefully that should augur well for the coming times. I think if we see overall, there is a movement more towards the premium, and maybe that is also a strategy of the company. But that is there we see a movement more towards the premium products as well. If you take fans, it is more towards energy saving products. If you take switchgear segment, it is more towards automation and electronics. So there is a movement towards premium segment overall.
Okay, that's Havells there, the comment coming in from the management. Let's stay with earnings. Cyient DLM is holding up almost 4% after reacting to numbers. It seems to have been another good quarter for this company as well. We also caught up with the management today to discuss growth prospects from here on. Upasana is back with some of the key highlights from that conversation. Upasana.
Well, certainly, company has reported a good set of numbers. Overall, it was a good quarter for the company. Revenue, EBITDA, PAT stood above street estimates, while margin stood much above the street estimates. Now, coming to the numbers, the revenue saw an uptick of 18% on a YoY basis. EBITDA margin saw an uptick of 51%, and EBITDA margin saw an uptick of 290 basis points at 13.4%. PAT saw an uptick of 37%, and order book, which was seeing a downtick since past 7 quarters, stood nearly around 1900 crore with a downtick of 12% on a YoY basis and 11% sequentially. Now, this when it comes to the margins of the company, this expansion in margins was mainly driven due to change in the product mix, one-off impact of Altac acquisition, and also operational efficiencies, what the company has indicated. Now, management joined us earlier this morning, and management says that the 200 basis impact on margins is mainly due to one-off this quarter, and it expects double-digit margin, that is around 10 to 14% going forward. And it has also highlighted that Q1 FY26 is likely to be soft, but overall maintains a positive outlook for FY26. Coming to the order book now, it says that the order book will see upward trajectory Q2 FY26 onwards, and in terms of revenue mix of the company is likely to remain stable going forward. And it is also indicated that the A&D segment, that is aerospace and defense segment, will drop the overall mix by at least 5%, while industrial segment will see an uptick going forward. So overall, strong set of numbers and upbeat management commentary from Cyient DLM.
All right, thanks a lot for that, Upasana. That's about Cyient DLM. The stock's doing extremely well. Another couple of stocks which are doing well, we have Sona, BLW Procession, we have IIFL Finance, which has picked pace as well, and Macrotech Developers ahead of numbers in the next couple of days. That stock too has moved higher. But let's move focus away from the stock markets and address the tragic incident that took place last evening. At least 26 civilians, including 2 foreigners, were killed in a terror attack in Pahalgam in Jammu and Kashmir last evening. The Pakistan-based Resistance Front has claimed responsibility for this attack, which was the deadliest that we've seen in the region since the 2019 Pulwama attacks. Following the attacks, Prime Minister Narendra Modi cut short his visit to Saudi Arabia to return to India. Home Minister Amit Shah too reached the attack site in Pahalgam and spoke to the army officers, the top army commanders, and the JNK DGP after visiting Srinagar to take stock of the situation and paying respect to those who lost their lives in the attacks. Sources also tell CNBC-TV18 that the Cabinet Committee on Security is likely to meet today to decide on the course of action following the attacks. That's not all. We also have with us CNN News 18's Ishan Vani reporting live from the attacking site. Ishan.
CNN News 18 has managed to reach Baisaran Valley. It might look beautiful to you, but this is the scene of that carnage which unfolded yesterday here. And massive firing was witnessed in this valley. Though there is a massive deployment in these mountains behind me, but just now, the Union Home Minister has instructed security forces to carry on massive operations around this place. You will still see a large presence of security forces behind me. We are among the first few channels to reach here by foot after trekking for several hours, and the Home Minister has just left behind us in a helicopter. We have been told that best possible treatment and care will be done to them who are injured right now, and the government has also announced compensation. But look at the situation here. Must have been really deadly yesterday when the things unfolded. You can also notice somebody's slippers, shoes and belongings are still lying around. And this is the scene where the NIA and the forces are also investigating now to what really transpired yesterday. Ishan Vani from Baisaran for CNN News 18.
Okay, an eerie sort of silence today at that same spot, which otherwise, as Ishan said, looks so absolutely scenic and beautiful. In order to ease potential travel roadblocks following this attack, Union Civil Aviation Minister Ram Mohan Naidu yesterday spoke with Union Home Minister Amit Shah about arranging more flights from Srinagar to Delhi and Mumbai today. The ministry has arranged 4 new flights, 2 each to Delhi and Mumbai from Srinagar, and will monitor fares to ensure they don't spike. The ministry is also monitoring the situation and, based on demand, will be in touch with airlines to do more. DGCA has issued an advisory asking airlines to increase the number of flights from Srinagar. According to the DGCA, there's an unexpected demand from tourists seeking to return to their homes. Right, wishing and praying for safety for everyone around in the area. Well, we'll take a break on that note, come back on the other side. Pritesh Mehta of Yes Securities joins in with some trading strategies.
Welcome back. You're watching us here on Halftime Report. Perfect time to get you up to speed with what's taking place in the F&O end of things. The market's consolidating with a tug of war between the Nifty Bank as well as the Nifty IT, something that we've been speaking about all through the day so far. So if you look at it, the Nifty up around 0.2%, and that's because the Nifty Bank is down 0.8%. The Nifty IT index has actually done a lot better with an up move of 4.5%, continues to do even well. If you look at the broader markets as well, the mid-cap as well as the small-cap indices, for most part of the day, we had the mid-cap index which was underperforming. Now it's begun to outperform. The small-cap index still struggling a little as compared to the other frontline indices, and that's witnessed in the advanced decline ratio as well. Yes, we had about 2 stocks, declining for every stock which was advancing, but swiftly those lines have seemed to come closer. Still, about 1,500 stocks which are in the red for about 1,000 stocks which are in the green itself. All of this, follows the India VIX rising by about 4% as well, ahead of April series expiry tomorrow. The Nifty IT, what it's done is, with the kind of move that it's seen, it's crossed past the 20-day moving average as well of 34,989. Consistently holding above that. So near-term moving averages on the Nifty IT taking care of. The April series expiry that takes place tomorrow has a couple of levels that we need to keep an eye out on. On the way up, 24,300 call has seen a fair amount of writing, as has the 24,300 call. Both of them have a 24,350 call. Both of them have a premium of almost 35-40 rupees, telling you that levels upwards of 24,350 to 24,400 could see some sort of supply, issues coming in or resistance in the market, so long as the Nifty Bank continues to consolidate. If the Nifty Bank pulls higher, then these writers will have to go for cover. And at the same time, we are seeing strong support at around the 24,100 mark. And that's largely because the put writing that we've seen at 24,200 and also the 200-day moving average comes in at 24,51, which is an important technical support too. The one stock that I'm watching out for 1 day ahead of expiry may re-enter F&O ban after exiting it just last evening is Hindustan Copper. So we'll watch out for that one. Short point of the Nifty, 24,100 to 24,350 is the broad range. If the Nifty Bank outperforms, then all bets are off on the short side. Perhaps those shorts will cover their positions.
Okay, all right. So that's the F&O setup for the time being. We've got Pritesh Mehta, Executive Vice President at Yes Securities, joining in with some thoughts. Pritesh, good to have you on the show. So it's a slightly calmer, slightly quiet day. There's some correction on the Nifty Bank and banking stocks. What would your trades be now?
Good afternoon. I think we want this sort of days after the kind of rally that we have seen last couple of weeks. So in fact, you've done quite well as far as the headline index is concerned. Bank Nifty financials are outperformed. But see, we are talking about 5 gap-up starts on the Nifty in last 9 trading sessions. So I think a bit of some normalcy needs to return. And this is what we are observing on the screen. As far as Bank Nifty is concerned, Bank Nifty is now witnessing the disparity at an extreme peak. So difference between price and the average is at a very high level. So in this scenario, we could see some sort of price or time correction coming in Bank Nifty. And for Nifty, 24,300, 24,400 zone, that is very crucial, because if you look at the historical action between September 2024 peak and March 2025 low, this is the zone where Nifty has spent most amount of time. It won't be easy for Nifty to go about. So I think we could see a bit of consolidation taking place. It is going to be a classic stock-specific market now.
All right. Individual stocks, what are you looking at, Pritesh?
Yeah. So, we have created a customized insurance index that is doing extremely well. It has reversed and now moving higher. We have witnessed follow-through moves. So one stock that we like from this space is ICICI GI. The stock is witnessing a base breakout. We are witnessing, a bullish turtle breakout also. So buy for a target of 2100. Stop loss will be 1800. The second that we like is from the PSU banking space. Now, PSU banking space bank index has given a breakout of a 45-degree downward trend line on point of chart. And now we are witnessing follow-through moves. So buy Baroda, Bank of Baroda, for a target of 280, and stop loss will be 239.
Okay, all right. Pritesh got that. Thank you very much for joining in. Thank you for the updates over there. We'll take a quick break, come back on the other side, more on the markets, and we're putting the spotlight now on Waaree Energies and Vardhaman's Special Steels. Welcome back. Here with us on Halftime Report. Now, the banking index, of course, hit its record high yesterday, and it's seen a pretty sharp surge over the last couple of weeks. Bank stocks have been rallying. Ritu is here to tell us what is fueling this rally from a regulatory perspective.
Well, a spate of positive developments for the banking system that could explain the rally we're seeing in banking stocks. But at the heart of it is a regulatory environment that is turning more supportive under RBI Governor Sanjay Malhotra. RBI has deferred tighter project finance norms, and they've even provided banks additional time to comply with these new LCR requirements, and to the street that is signaling a clear pro-growth stance. Adding to the momentum, systemic liquidity has also flipped into surplus after a 4-month deficit, with the RBI injecting more than 15.5 lakh crores in the system in the recent months through OMOs, VRRs and forex swaps. Now, while the recent 50 basis point rate cut may weigh on bank NIMs, it is aimed at boosting credit growth and demand, and CRISIL expects credit growth to rise by up to 200 basis points this fiscal, helped by these tailwinds. The strong show by banks like HDFC and ICICI Bank in their fourth quarter has also helped boost sentiments. Now, on the regulatory front, these latest LCR relaxations are a big positive because compared to earlier draft norms, the final rules are more lenient, and they are expected to improve the aggregate LCR of banks by 600 basis points, freeing up almost 3 lakh crores of lendable resources and potentially lifting the overall credit growth by up to 1.5%, according to ICRA estimates. RBI also recently lowered the risk weight on bank lending to NBFCs and MFIs. That could free up an estimated 40,000 crores of capital. Now, co-lending norms, they've also been expanded to include all sectors and all regulated entities, and even priority sector lending norms have been revised, enhancing the loan limits and broadening the scope for renewable and housing credit. So put together, it is a powerful combination of ample liquidity, regulatory easing, and strong earnings that is fueling this banking rally. But that said, not all concerns are off the table. Deposit and credit growth momentum remains a key watch point, and there are still some lingering risks around asset quality issues in unsecured loans and microfinance segment.
All right, Ritu, thanks a lot for that. In fact, earlier we spoke with banking veterans Dinesh Khara and Sanjeev Chadda on the recent actions taken by the RBI and how they can impact the larger industry. Hear out.
The industry was always reaching out to RBI and was making a very appeal, significant appeal in terms of ensuring that the liquidity should not become a challenge. Particularly, I'm talking in the context of LCR, and I'm glad that the guidelines which have come in, it's actually a middle path. If at all you look at it as compared to what it was, and now what it will be from the 1st of April 26, it's more like a middle path. I would say that it has always been a collaborative approach, but I think as a regulator, they are very mindful in terms of the situations which are obtaining, and based upon that, whatever elbow room is available, I would say that they are willing to accommodate the banking system. Very mindful of the fact that growth is the need of the hour, and unless and until the banking sector is given the required support, growth may not really happen.
I think particularly when it comes to the LCR, rate cuts already were there. And therefore, now if you want that the rate cuts should be transmitted, it was important that liquidity should be eased. Banks should not be looking over their shoulders in terms of what is going to be happening in 6 or 8 months' time. So I think while you are right in terms of the fact that there may be some signals to read, but these the changes that are there are perfectly understandable and justifiable in terms of the mandate of a central bank to ensure that there is growth, to make sure that there is counter-cyclicality in policy, and also make sure that the rate cuts actually get transmitted in a broader sense. When it comes to the runoff factor when it comes to digital deposits has been increased by 2.5%. But I think the stance of the RBI would seem to suggest that they are fully cognizant of prudential requirements, but they will make sure that banks get sufficient time to adjust so that any policy action of the RBI is non-disruptive as far as growth is concerned.
All right, that's Mr. Sanjeev Chadha, former CMD at Bank of Baroda, weighing in on all the changes that the RBI has announced of late. Let's move on. Waaree Energies is in the spotlight, and for the right reasons. Stock's been rallying almost 13% after reporting a strong set of numbers for the fourth quarter. So what has worked for Waaree? Is it just the numbers? Is it the fact that there are tariffs on a lot of the other Asian renewable energy equipment makers? Let's ask Vivek. Vivek, over to you.
Well, that's right. So the 13% up move today that you're seeing is on top of the close to 7% up move that the stock saw yesterday. So, hefty gains coming in for Waaree Energy in the last couple of trading sessions. First, let's have a look at the numbers that came in post-market hours yesterday. When you're talking about the revenue, strong execution, almost 36.5% higher, about the 4,000 crore mark, EBITDA higher by more than doubling on a year-on-year basis. Margins, almost 900 basis points improvement, profit after tax. If you see, almost 34% improvement on a year-on-year basis. As far as the order book is concerned, slight moderation on a sequential basis, 25 gigawatts. So order book now stands at 47,000 crore, versus the little over 50,000 crores that the company had at the end of Q3. Now, almost a 50-50 split in terms of domestic versus export is where the order book currently stands at. What is it that the street likes? Well, the street likes the fact that the company has given a very strong EBITDA guidance for FY26. Over 5,500 crores is what the company is currently targeting, implying that there could be a doubling of EBITDA. Along with that, when you're talking about the kind of guidance that the company has given as far as ingots and wafers capacity addition is concerned, they're expecting a 6 gigawatt facility to be ready by FY27. Modules current capacity at 15 gigawatt. They are expecting 4.8 gigawatt to be added in the next couple of financial years. You also mentioned about the tariffs. Now, tariffs, remember, it's a derivative impact. USA has spoken about duties up to the range of 3,400% when it comes to certain countries. From as low as 7% to as high as 3,500% is what the US is looking to target. Southeast Asian countries, so look at Vietnam, Cambodia, a lot of these places that the US believes China has been using as a proxy to go ahead and supply solar cells, modules, ingots, as well as wafers. Waaree, as well as Premier Energies, two large Indian companies that do supply, solar cell value chain components to the USA stand to benefit in case the rates to come down or they become a lot more competitive. Volumes go up as they become a lot more competitive as far as the US market is concerned.
Right, Vivek, thanks a lot for that. We're talking about, stocks reacting to good numbers coming in. Vardhaman Specialties is the other one, which is zooming today. The company reported a subdued set of numbers, but the reason why the stock is moving higher is because of the capex announcement that they've made. Nigel joins in with more. Nigel.
Well, that's right. Vardhaman Steel, they reported their numbers. And in fact, the numbers were nothing too great to look into. So on the revenue front, there was a bit of a degrowth. It was down by close to around 3%. The EBITDA number as well came down from around 57 crores to sub 40 crores. And margins did see a compression from around 13% to around 9%. So no great shakes out there. Even if you're looking at the unit economics, the total volume number, well, that was mildly higher by close to 3%. You need to note in the past quarter, they had a bit of a shutdown as well, but still 3% volume growth is what they delivered. On the EBITDA per ton, from around 10,000 rupees, it came down to around 7,000 rupees or thereabouts. So out there as well, there were some pressure signs. But the reason that the street is excited is because they have announced this big capex. They have announced a greenfield steel plant that they're looking to set up in Punjab. And they're saying the total capacity will be of around 500,000 tons of billet capacity. They're going to give a few more details. The total capital expenditure they're looking at is around 2,000 crores. And they say it's going to be a mix, of debt, internal accruals, as well as some equity. Now, the street will be speculating how do they do this. Remember, the Japanese company, Aichi, they have close to around 11% stake in Vardhaman Specialty Steel. So will they be part of it? Well, we'll have to wait by for that. The commissioning of this plant, they're talking about by 2030 or thereabouts. So numbers not too great, but the street is excited about prospects of this greenfield steel project that they're talking about. Back to you.
All right, Nigel, thanks very much for that. Excited for sure, 20% locked up in circuit there. We'll take a quick break on that note. On the other side, we'll put the spotlight on our special offering, Quarter Se Quarter Tak. Manglam is going to bring us expectations from the FMCG sector. Welcome back. As promised, it's time for a special offering, Quarter Se Quarter Tak. And as promised, Mangalam has now moved over to the wall to tell us about whether the FMCG space can offer any bright sparks. Mangalam, we've been waiting for those sparks for many quarters. Is it going to be any different?
Alas, this time not perhaps in the numbers, but the reactions may be a little different. And which is why, to summarize the expectations from the FMCG sector this time around, I'll use the old ad tagline. Same, yet different. Why so? Because it's going to be a quarter of muted staples volume growth, good rural recovery, urban outlook improving post-budget but still not out of the woods. Raw material prices, they remain volatile. Palm is off highs, but remember, year on year it's still high. There is strong competition across categories, ripe for disruption as well. But some leaders are making a bit of a comeback. Discretionary, like jewelry, beauty, personal care, quick service restaurants, value retail, are all doing well. From the updates that we have so far, it's the discretionary that has outperformed. So we have jewelry names like Kalyan Jewellers and Titan, top of the pops, 25-37% growth. Trend 2, despite a 28% growth, which is a lot slower than its own past performance, was among the top quartile that it came to growth itself. Nykaa too continues to outperform the sector this time around. We did see some revival in revenue growth from names like V-Mart and D-Mart as well. For D-Mart, a large part of it was led by store expansion, not same-store sales growth. The staples, however, they continue to drum in their own muted beats. Dabur said its India business was actually decline in mid-single digits, and there would be a compression of 150 to 175 basis points in their margins. Marico, on the other hand, saw sequential uptick in underlying volume growth, some reduction in the margin compression, and maybe going forward they would see further improvement out there, as did Godrej Consumer, with its underlying volume growth expected to be mid-single digits after a flattish third quarter itself. What are we expecting from the companies that are reporting their numbers this time around? Not very different from what we saw in the third quarter, apart from the fact that we will see a notable underperformance for Asian Paints, 1 to 2% revenue decline, 2 to 6% EBITDA decline as well. Margin compression is expected for both Britannia as well as Tata Consumer on account of high input prices. HUL likely to report flattish volume growth, low single-digit revenue growth, EBITDA as well around that 1.5 to 2% mark. But what's different, however, is that the expectations of a better FY26 are a lot more. Why is that? Because of projection of a normal monsoon, impact on consumption led by tax cuts and government SOPs, improving urban demand outlook after the weakness that we've seen in urban India, and a lot of acquisitions made by companies in the recent past could see scale up begin as well. In terms of valuations, the sector has never been cheap, but this time around, after a spate of underperformance, multiples are near or below 5-year average for most of the companies. So HUL, 5-year average 52, stock trading at 47, ITC around 2022 itself, Godrej Consumer at 5-year average, Asian Paints, look at the D rating from 60 times to 48 times, and Nestle is trading around 61 times, which is much lower than its 5-year average of 65 as well. And that may give some solace to those looking to invest in the sector at the ebb of the cycle. And I'm not alone. We've seen a few brokerage upgrades coming by as well on their outlook on this sector. What will set this quarter apart from the previous one is that management commentary will be a lot more optimistic than earlier, and as a result of which, weak results may not be as punished in the stock market as earlier. Therefore, same, yet different for the FMCG sector.
What's different is, at least in that table of yours, I didn't see anything above 50 times. Usually for FMCG, and back in the day, 60, 70 was like as good as 5 or 6.
Exactly, which is why it's same, yet different.
Yet different. There's something different about the numbers this time. Thank you so much for that. Well, with that, we do have to slip into another very quick break. Come back on the other side, and Manisha Gupta will join in with the latest commodity market action. Today, she'll have Sanjeev Asthana, President of the Solvent Extractors Association of India, with her. Welcome back. Here with us on Halftime Report. Quick check on the market. It's actually quite okay. The Nifty is now trying to find some momentum again. A little bit of an uptick there, about 60 points higher. Bank Nifty is still underperforming, but it's all about the IT stocks today. And they continue to take leadership position. HCL Tech, for instance, the gain is almost 8% as we speak. So looking good over there. And some of these FMCG stocks that we were just discussing with Mangalam, Lever, Eternal, Nestle, there's a fair amount of buying even in this side of the market. Speaking of FMCG, good time to then take a deviation and move towards commodities. We have Manisha joining in, and as promised, she has Mr. Sanjeev Asthana, President of the Solvent Extractors Association of India, with her today. Manisha.
Well, thank you so much for that, Surbhi. And there's so much to talk about when it comes to FMCG, but I'm going to focus on the edible oil as a sector right now. Mr. Asthana, thank you so much for joining in. And I'll start with the kind of tie-up that you've recently done with the TechnoServe. This is to do with increasing fortification when it comes to edible oil as a sector. What is it about? And I'll begin with that. And what does it mean to you as an industry and an association?
So, Manisha, thanks. I think you've picked up a very good subject. India, as you know, is passing through its own challenges on the micronutrient deficiencies, and fortification is one of the key tools that has been used by different sectors. Edible oil, in particular, has been doing, fortification with vitamin A and D for long years. TechnoServe is a US-based, organization, not-for-profit, which focuses large parts of their energy on nutrition. They work across the world in different continents, different segments. They run a very unique program called Millers for Nutrition, which essentially partners with millers across the world in different areas. So, for example, in this case, for solvent extractors, it is with all the refiners of edible oils in the country. And the idea being that, they would be able to bring in the best practices on fortification. They would be able to do a lot of, capacity building of the millers in the way the best manufacturing practices ought to be followed. And likewise, the best, the global hygiene practices they would be bringing to the table. And C is a perfect organization for them to partner with in the country to take this forward.
Mr. Asthana, there's just so much that I want to speak to you about. One, of course, is fortification and this tie-up that you have done. The other is the C approaching the government to revive the non-GM soy meal exports to US. I mean, we do understand that there are lots of conversations happening right now. Various sectors also have given their representations to the government, which is in negotiation with US right now. How are you looking at the non-GM meals featuring into this?
Non-GM meals, we've been strongly recommending to the government that when we get onto the negotiating table with the US, earlier India had a fairly good program which was, targeted both at the European markets and occasionally to the US markets as well. US pays a very high amount of premium for the soybean meal, which is non-GM variety. And India is a perfect spot, to fill in that demand. And it helps us also because Indian meal is looking for new homes where we can export. And US can be a perfect candidate for that. So our only recommendation to the government has been that you should explore seriously as to how the Indian non-GM soybean meal can be part of the the FTA that is signed or whatever agreement we arrive at finally with the US, that we should be able to find new homes for Indian soybean meal non-GM variety into the US markets.
Mr. Asthana, my third point of conversation with you is about the edible oil pouches of lower than a litre. I mean, I know this has been a discussion for some time now, and you guys have been talking about it. I remember C writing a letter in this regard as well. What really seems to be the concern right now, and is it anywhere close to getting addressed?
So concerns are twofold. In fact, last 2 days itself, we've been meeting a series of government officials. One that, under certain regulations, it was allowed, for the whole idea being that the consumer is aware of, what grammage they buy for. They're aware of the minimum retail price at which they're buying. But the fact remains, Manisha, that we all know that, in multiple different categories, the consumers in a lot of cases are not aware. So, for example, that when they buy a bottle of oil, they know that this is, 1 liter, this is what we consume, and this is how we've been using it always. But it doesn't necessarily work out that way. And, this has got reflected in very different ways, especially in the pouches. So the size of the pouch will remain same, but it has almost become like a race to the bottom, where from 910 grams, it continued to sort of go down. Now it's to a level of 850 grams, 810 grams, 750 grams. So our only recommendation to the government is that consumer, not in all cases, is as savvy to be able to determine as to what grammage he's paying for. And maybe perhaps the government should reconsider its order and try to bring certain amount of standardization to the grammage so that the industry players can play by the same rules. And it should benefit ultimately the consumer. So what we are recommending is very pro-consumer. Perhaps when the consumer becomes educated enough and is savvy enough or is extremely aware in terms of what exactly he's paying for, so then we can move on to that. But I don't believe that India is at a stage right now for consumer to be able to determine whether he's paying the same value for 850 grams or he's paying for the same 910 grams or even 780 grams. And I think that is something which is essentially not in favor of consumers, but is also helping unscrupulous elements within the industry to be also exploiting this loophole in some way or the other, and which is not helping the industry overall.
Mr. Asthana, I also want to talk about the prices now, because if you're looking at the palm oil prices now trading at almost at a 6-month lows, at par now, or perhaps a discount coming back versus the soybean and sunflower there. How have been the imports? We do understand Jan, Feb, March perhaps saw 3.5 to 4 lakh tons of palm imports into the country. Do you see this increasing, especially with the prices coming down? What's also your sense as we go into the summers in sense of edible oil imports?
So traditionally, the palm oil imports do tend to increase in the summers, and you're right that the palm oil imports were down. The main reason for that was it was trading almost at a very substantial premium to the soya and sun oil, and which is quite unprecedented. That market has corrected itself. So as we head into the summer season, the demand season picks up. We still have a marriage season in the month of right into the month of May. So my estimation is that not only will the imports of palm increase, I think palm will start buying back its share from soya as Indian soya crush season declines, as the the shipments out of South America continue. I believe that the palm oil imports should start to increase by at least 100 to 150,000 tons a month, and palm will start gaining its share versus both soya and sun.
Mr. Asthana, one final question, and this is on demand consumption growth going forward. We do understand that the PM has been pushing for it, and we've seen in any case the numbers decline. How do you read the overall numbers?
So numbers are, a function. I always believe that, how the consumers ultimately decide. And so while, Prime Minister's exhortation has been there in terms of lesser consumption, I believe that it was more to do with the prices earlier that we had on the inflation side. But as they tend to taper off, my feeling is the demand will sort of come back, and consumers will start responding quite actively, again, in terms of increased consumption. So my sense is that India this year, I'm talking of the full fiscal year, we should see consumption levels rising with the, tapered edible oil prices as well. So we should see a substantial uptick in the prices. In the consumption this year.
In the demand, yes, absolutely. Mr. Asthana, I want to thank you on that note, because you've answered all of my questions and I've spoken on various issues here. But I appreciate your time here at CNBC TV18. And with that, it's a wrap on Halftime Report. Business Lunch will take all the action ahead.